Okay, welcome everybody to episode 62 of the Volatility Barometer. So we've got a good show planned today. I know people appreciate when we execute live trades, and I'm going to be going over a strategy that always gets a lot of attention, the Wheel of Fun. I will, of course, explain why we call it the Wheel of Fun when we get to that. I know some of you who've been following my live streams, we have opened several of these in the past, and they've all gone well. We've pretty much had 100% success rate. So I'm going to do something a little bit different today. I'm actually going to take a trade on the VXX and see if we can get a little more action and excitement going, because all the trades we took in the past, we just opened them, they went well, we closed them, and not a whole lot happening. So let's see if we can ignite a little bit of excitement into the Wheel of Fun strategy. So thank you everybody for showing up. It's been a couple weeks and I've got a slightly new setup here. So just somebody who's watching this, make a quick comment if the audio is good. That's always my biggest fear. If audio is terrible, then the live stream is basically ruined. So just give me a little comment in the comment section, little thumbs up if the audio is decent. I think it's the right microphone, but you never know. I always have to watch it on the rebroadcast. So as you know, I don't do any sponsorship. I don't do any advertising. Don't send me any money for the super chats. You can ask any questions you want. But today's video sponsor is going to be me. I'm going to do a very, very short little blurb here just about VTS, just in case people want to know. There's actually something that has happened that we're going to be starting very soon. I think people are going to be quite interested in it. So this is today's email. Of course, when you sign up for VTS, you do get the full portfolio, all the trade signals. That's basically what people are signing up for. Then there's also a volatility dashboard with all of the data that we need, all of the volatility metrics that we tend to track, articles and videos for all of them. So that's all the standard stuff. But what we have done now is we have completed our Iron Condor strategy course. So there's 30 videos here. I know that Iron Condor strategies, something that a lot of people are interested in. It's basically because it's a market neutral strategy and you can plug it into pretty much anybody's portfolio. This is a non-directional strategy. So regardless of what people's net market exposure is, this does match up quite well to pretty much everybody. I won't say 100%, but certainly 95% of investors. And you can learn all about it in this course. There's a bunch of videos. I think it's about 5 hours of content. You can go through all 30 of these lessons. And yeah, there's still one remaining, I believe. I think lesson 28 is still coming. Yeah, you can see lesson 28 is missing there. That's going to be a breakdown of how Iron Condors perform during major market crashes. So that'll be the last video. But if you sign up now, for sure that'll be done by the time you get to it. That's lesson 28. But the really interesting thing is we are now going to do the same thing with our tactical volatility strategy. So this strategy here, we've done the Iron Condors course. Now we're going to move into the tactical volatility. And this strategy is what people are quite interested in. This is our volatility strategy. So SVXY, VXZ, with a little bit of gold for a safety position. And it's quite an extensive strategy. Sorry, I will scroll through this. Hopefully this doesn't make you dizzy. But a lot of work goes into stuff like this, and I'm going to be breaking it down for everybody in real time. So if people were to sign up for the community right now, you can see this kind of goes on forever. So pretty detailed strategy. I think you get the idea. But you can always sign up for VTS on the website. It's a free 2-week trial and see what you think. But if you're interested in learning about the volatility strategy, you can get those articles and videos as they are being released, and you can participate in that. So little self-promotion there, but hopefully you understand. I don't ever actually do promotions of any kind. So there you go. All right. Everybody says the audio is good. All right. Welcome, everybody. There are some questions already. So remember, again, don't super chat. Don't use any of those YouTube things. Just ask your questions. I'm going to do a little, probably it won't be very long today, 15, 20-minute presentation, and then we'll circle back and I will get to everybody's question. So I see there's a couple already there. Asking about the annual discount. That's a good sign. Somebody's on board for the full year. Another question there about performance. I will get to those in a second. So what I want to do today is, first of all, we are going to take a Wheel of Fun trade. But what I want to do is just recap very, very quickly what the Wheel of Fun is, because this might be your first live stream you've tuned in for. So let me just go through this very quickly. Let's see if I can do this in 3 minutes. What I'm essentially going to do, let's try to make this a little bigger. I'm essentially going to try to put together a very quick video, like a 2-minute video, and try to cover the whole thing as fast as possible. So every time we do it in the live stream, I'll just hit play on a little 2-minute video, and I won't have to go through this each time. But here we go, the wheel of fun. What I'm going to do is I'm going to explain this, and then when we take the live trade, everything that you don't understand in this first run through, it will make perfect sense. Trust me, we'll go through all of the numbers later on. And yeah, you'll get it immediately. This is quite simple. All right, so you start with a cash secured put on a security that is typically beaten down in price. What we're looking for is a little bit higher volatility, something that's down, because when you're selling a put option, of course, if it goes down below your strike price, that's when you get assigned the share. So you do want something that is beaten down recently. So you sell your cash secured put and you bring in some premium. This strategy is about premium collection. It's not about capital appreciation of the underlying security. So on expiration day, and you can do these 1 week in advance like we're going to do today, or you can do them typically 3 to 4 weeks is what I target. But regardless, on expiration day, one of two things can happen. Your short put can either expire in the money, in which case it was below the strike price, and you would now be assigned the long shares. So if you sold one cash secured put, one option contract is 100 shares. The underlying, you would wake up Monday morning, basically you would have 100 shares of the security sitting there in your account. That's one thing. The second thing that could happen is it expires out of the money. This would be the didn't reach the put strike that you sold. In this case, nothing happens. In both of these, you keep your premium, so this is what the strategy is about. You make that money. But in this case, trade is gone, you're back in cash, and you'd basically just go find a new target, or quite oftentimes, I will just go right back into the same security and do the whole thing again. There's a little wheel over here. This is why I call it the wheel of fun. This is just some stupid name that I made up. It's not an official strategy or anything. All right, so the goal here, though, is to get these shares. And then when you get the shares, again, we're not interested in capital appreciation, so we're going to immediately sell a covered call, collect more premium. That premium is ours no matter what happens. And again, now that we have a covered call with the shares, two things can happen. It can either expire in the money, in which case this is good. We lose the shares, we're back in cash, and we would go right back to the beginning, again, either on the same security or we'll just find a new target. The other thing that can happen is it expires out of the money, meaning your covered call, nothing really happens. You will keep your shares and you'll just do the little wheel over here. You'll just repeat the covered call, and then two things can happen. If it doesn't go over the strike price again, you're right back into the covered call. And sometimes this can go for 2 or 3 months. These little wheels can go back and forth. But the reason we call it the wheel of fun, of course, you can see what's happening. In an ideal situation, you sell the put, it expires in the money, hopefully slightly, not too deep in the money. You get that assigned shares, then you sell your covered call, you bring in even more premium, then your covered call gets called, your shares get called away, and you're back in cash, and you just go around the wheel. So that is a wheel of fun on the put side. Now, it's also worth noting that you can do a wheel of fun on the call side just as easily. There's just a slight difference here in that when you sell the cash secured call, again, you're collecting the premium. If you get assigned, instead of getting the shares, because you sold a call, you are now getting assigned short shares. So you would be short 100 shares of whatever security you're in. And then, of course, the lingo's a little bit different, but you sell a covered put option. Instead of, in this case, a covered call on shares, you sell a covered put on a short. Same thing. And then hopefully it expires in the money, you lose the shares, you go right back to the beginning. Again, you can work this wheel. So this would be the case if something was maybe very overvalued and it was a stock that was reaching the upper bound limits of where you think it's going to go, you could initiate on a call. Today, of course, spoiler, we are doing the VXX. Of course, we're going to be doing the put options. So that is the basic wheel of fun. Hopefully I was able to do that in about 2 or 3 minutes. And, pretty simple, right? It's a premium collecting strategy. We don't really care about the underlying security. But the one thing that we have to keep in mind is that when you sell put options, this is where people get into trouble. They think, or they tell themselves a story that, oh, I'm just getting paid to do something that I would do anyway. So they get a little bit reckless. They don't understand that when you sell a put option, you're not actually reducing your downside risk very much at all. These premiums that we bring in is the only insulation that you are getting against a downward move in the stock. It's going to be pennies, right? As you'll see in a second, probably 1 to 2% only. So it's not like you're protecting your downside very much. You are essentially subject to nearly the full downside of whatever security you're doing this on. So we need a stop loss. You don't want to ride one of these wheels, which is just a premium collection strategy. You don't want to ride that down 20 or 30% and end up being so far out of the money when you sell those covered calls that you get 1 cent when you're selling the covered calls. That's not part of the strategy. So we will be implementing a stop loss, and I'll go through the numbers on that. So let's go ahead. I think we're ready to do an actual trade. SPX right now, flat. Hot coffee. All right. S&P is flat. Let's see what the VXX is doing. Good. So it's down. That was good. We actually do want it as low as possible. And obviously lately, when I say low as possible, this is the VXX. It's been going down quite violently lately. It seems the market is getting quite comfortable with lower volatility levels, which is good. But this is also pretty good for our trade. So what I'm going to do, this is a beaten down stock, right? Intentionally, of course, it's designed that way. But we are going to initiate right there on step 1, selling a cash secured put on the VXX. So now what we need to do is we need to choose, excuse me, we need to choose the strike, or first of all, the expiration. Now, I already said I'm going to do 7 days. The only reason I'm going to do 7 days, typically I would probably do 21, maybe 14, but typically around 21. The reason I'm going to do 7 is because next week I want to have some action so we can do a follow-up trade. That's what I said at the beginning. I'm actually going to try to induce a trade that has a little bit of excitement here. So the first thing that we would do is we would choose the expiration, 7 days, which is 5 trading days. The second thing we need to do is choose the strike price to sell our put option at. And that's where my daily email comes in, because every single day in the volatility dashboard for the VTS dashboard, among other things in our statistics, one thing we do have is the crush levels for all the volatility ETFs and the surge level for the inverse ones, SVIX, SVXY. But there's the VXX right there, that first one. So we can see right now the daily decay factor, it's pretty strong because the VIX futures have very strong roll yield right now. It's decaying 0.66% per day. So we can look at the 5-day. Remember, we are doing a 7-day contract, but that's calendar days. There's 5 trading days. So we can just look at this one. We are expecting it to be 2347 by next Friday. And of course, this is not an exact science. This is just a long-term 19-year historical estimation on the decay factor of the VXX. I can't say for sure whether it's going to under or overshoot. That's just based on the current decay factor right now. So we're expecting about 2350. So conveniently, there is a 2350 strike. So this is the one that we would be doing. 5 days from now, we are probably expecting something like this. Let me make that look a little nicer. And there we go. So here's the current price right there. Essentially, we are selling the 2350 strike, and then we are collecting a little bit of a premium here. So our break even is basically the strike plus the premium we collect. But that 2350 is the threshold point where right here in step 2, one of 2 things is going to happen. It's either going to be in the money and we're going to get the shares, in which case, let's say the VXX went down to right about there, right? It's below 2350, so I'm going to wake up on the following Monday morning with 100 long shares of the VXX in my account. That's what would happen. Otherwise, what could happen is it's out of the money. Nothing happens, you repeat. Out of the money would be somewhere above 2350. Nothing happens, I would just keep my roughly 35 cents. Good to go. I would probably, unless the VXX spikes violently, I would probably just circle back in the very next week, sell another one. So that's the initial wheel of fun right there, is that we are selling the 2350. We're going to wait to see what happens. We have analyzed that, look, it's probably going to be around 2350 if the decay factor persists for another 5 days, and we are willing to take that risk. So the last thing that I would do is I would go ahead into the trade tab, and let's go ahead and execute this. Now, the first thing This is one contract. Now, what I will typically do for the Wheel of Fun, I would take, say, 20% allocation of my portfolio for any individual strategy. We typically trade about, all 5 of our strategies currently have 20%. Because a put option, I want to be very careful with my words here. I don't want to encourage too many people to get themselves into trouble here. But because a short put option has no upside volatility spike risk, meaning that if the market crashes on Monday, I'm net long equities right now, basically. So those positions are going to suffer. But a short put option cannot get hurt additionally from that move. So even though I don't technically have an allocation in my portfolio for this type of trade, I always just allow myself to put them on basically whenever I want. Whenever the VXX has decayed to a certain level and further catastrophic crashes, or vol crush as we call it, if it's less and less likely, I just give myself a green light to go ahead and do these. Because as you can imagine, I can actually just show you, we are net long equities in 2 of these strategies. 2 times the NASDAQ in the defensive and 2 times the S&P in the strategic. So I am actually in the QLD with 20% of my money and SSO with 20% of my money. The VXX short put option is mathematically inverse both of those positions. So I can't exacerbate my issues if the market crashes. The VXX put option, of course, the price will spike this way. I'm just going to get my money. So I do have a lot of buying power because this is the way that margin accounts work. Again, like I said, I just kind of allow myself to take these trades pretty much anytime I want. And it's not technically in my portfolio, but this is just side trading that I do. Again, I want to be careful with my words. If you take a large allocation, you can get into some trouble. Obviously, if volatility crushes way down here, you're going to be losing money, right? The further it goes, remember, you're not protected against downside risk. I only get a 36-cent insulation here, so you don't want to sell too much. But the point is, let's just go ahead and do a 20% allocation. So remember, this is cash secured, which means I'm going to reserve the capital as if I'm buying the outright shares. So if I have to buy 100 shares for every contract at $23.50, what I can do is I can just take basically $23,000, 20% allocation roughly of this account, and I can divide by 23. Where did my calculator go? Divide by 23.50, right? Hopefully everybody can see this little calculator here. So this is 9.78, basically 10 shares. So instead of doing 1, I'm going to do 10. That's it. So this is now a 20% allocation of my portfolio. And again, it's not going to get me into any trouble because if the VXX spikes, great, I keep my money. If it goes down, well, I'm 2 times net long equities in 2 different strategies. So if it goes down, way down to here, obviously my NASDAQ and S&P positions are going to make far more money. I would be quite happy if that was the case, to be honest. If the VXX goes all the way down here, that would be really good for my overall portfolio. So I'm not worried at all. I'm going to do a 20% allocation. And now the last thing we do is we try to get the best we can. So here's the mid at 37, natural at 36. There's no harm in trying to get the mid. And in fact, if you wanted to do what we call the 30-second rule, just quick reminder, there is actually a lesson on the 30-second rule in the Iron Condor course. I basically teach how to get the best execution prices when you trade. But here it is, 38. I can go 1 penny above the mid, and I can execute this. There we go. It's going to go into the queue. I'm not going to get it. The toss numbers are usually quite accurate, so I do think it's 37 right now. But I would wait my 30 seconds just to see. These are computers and see if it matches it up. I'm not going to wait because this is a live stream. So then you would just adjust it 1 penny each time until you actually get this thing executed. So now I'm trying to get 37, which is right on that mid price. The natural's 36.50 right now. So I'm probably not going to get 37 unless the market moves in my favor. No point waiting. It's a live stream. Let's just get this going. Let's just drop it down to 36 and we'll see if we can get that one. I suspect, yeah, there we go. I suspect that one will go through. And here we go. Now, the last thing that I want to show everybody, remember I did mention that we need a stop loss. So the current price is right here. This is our live trade. Okay. What I do is I use a 10% total value stop loss. What this means is, including the premium and every cycle going forward, I will track if at any point in time this entire trade and all the cycles exceeds a 10% total value loss. That's my signal. I will just cut my losses and I will move on. I'm willing to lose 10%, which means I can get as aggressive as I want with these strikes. It doesn't really matter. I can sell the put options. I can sell the covered calls. I can make as much as I want. But if I ever lose more than 10%, I'm out. So how do you calculate that? Well, in the first one, this is very easy. I allocated $23,000. So I'm allowed to lose $2,300. I can just go down and I can find 2,300, which is right there. And I can just say that if the VXX goes lower than 2085, I'm going to be down 10% and I'm just going to cut my losses. It's fine. Remember, it's a 20% allocation. 10% is actually 2% of my money. But that's it. That's the stop loss. As long as the VXX is playing somewhere in this range, I don't really care what's happening. And to be perfectly honest with you, I kind of do hope that I get assigned these shares. Because if you look at here, I sold it for 36 cents, right? But the covered call on the other side, if I do get assigned, typically you can make a little bit more on the covered call, especially when you're talking about the VXX or the UVXY. You can see the one strike out of the money covered call is actually paying pretty decent money. And I'm going to be extremely aggressive with that covered call. I don't want the shares. I don't want any capital appreciation. I'm just going to be a super aggressive covered call, get as much as I can and get rid of those shares. So 36 cents might not seem like much in a 1 week trade. 36 cents divided by 23.50 is what I would be assigned at, right? You're talking about, for a 1 week trade, a 1.5% return. But I'm planning to do this every week until I get assigned the shares and then I get the bigger covered call. So I could probably make about 7-8% on this trade in a month. If everything goes as planned, and it's trading, it doesn't always go as planned, but if it does, I can expect to make a decent return on this strategy. It's not something that you're ever going to make 100% a year on. So this isn't some, just go all in type of strategy. It's more consistent. And again, you do have to be careful about that downside exposure. In this case, VXX, go as low as it goes. I mean, it's always beneficial if the VXX goes down for me. We are, of course, short vol traders, and we do use 2 times net long equities. So the more volatility crush, the better, to be honest. But yeah, you can actually make a decent return. I've had years where I've been trading this strategy for probably 15 years. And I think probably my best year, I've made almost 40% in a year. And not sure I've ever had a losing year, to be honest. I've had years where it's basically flat. Sometimes the market just does not cooperate and you take a big loss or you hit a couple of those 10% stop losses. You can be flat. But typically you're looking at about 12 to 15%, 18%, something around there. It's actually a really solid, stable strategy. So hopefully we can get a little bit of action. Hopefully we get assigned those VXX shares. And next week I can sell a super aggressive covered call. That's the plan anyway. So hopefully everybody followed along there. I will put together a video that gets the basis of the strategy down a little bit more consistent. But you can see this is not overly complicated. We are now in this stage here. We're just waiting to see what happens at expiration. So I will let this go right to next Friday's expiration. And on next Friday's live stream, we will summarize it. We'll see where it's at. And yeah, should be good. I do sometimes do the VXX, the UVXY. They're good, like I said, because down is always beneficial. So there's a ton of questions from someone called Uncommon Sense. Interesting. I'll have to go through all that. But one thing that I wanted to go through really quickly, this is just kind of a side rant. Let's move on to the next segment. It should only take me 3 or 4 minutes to talk about it, but here we go. All right, so I get a lot of emails from, somebody said you lost me. Am I still on? Everything looks fine on my end. Maybe it's you. This person said lost you. Huh. Interesting. I'm going to just keep going because, I mean, what do I know? I will only ever know that on the rebroadcast. So here we go. So I get a lot of emails from people talking about how to level up in life, typically young men, but pretty much everybody of every age has issues with what I'm going to be talking about, especially in this social media age, where I'm sure you've heard the old saying, your network is your net worth. True-ish, not really, but kind of. There's some truth in there. Or you've probably heard people say that you're the average of the 5 people you hang out with. I think that one's probably more true if you are, hanging out with, I don't mean to disparage anybody, but if you're hanging around with 5 broke people, you're probably going to be the 6th. If you're hanging around with 5 really successful, driven entrepreneurs, you're probably going to be the 6th. So what people struggle with, though, is once you leave school, it's actually really difficult to get into any networks, right? It's hard to meet people. Where do you go to meet all these people? How do you get into better groups? So the one thing that I always tell people is the easiest way to do it is to buy yourself into a better room. So this is not always possible, but just a quick idea would be buy a supercar, buy a Ferrari, buy some type of cool car, buy the Corvette C8 Z06, get one of those, join a supercar group. The guys in that group, they're going to lean on the side of successful entrepreneurs, C-suite level, people. And you can buy yourself into good rooms. If you got a lot of money, you can buy a yacht and go join a yacht club. It's all good. But because I do have a background in golf, of course, I was a professional golfer many years ago, I wanted to remind people of just how effective it could be to take up golf. Right? It's a lot cheaper than a Ferrari, a lot cheaper than buying yourself a Lamborghini. So the one thing about golf is it basically crosses all industries. And I've been a member at private golf clubs in my life. So, I have a lot of experience with this. But one thing that you can do is for not a whole lot of money, you can actually buy yourself into that better group. So I'm basically speaking directly to about 2 or 3 people just this week that emailed me this question. But this obviously applies to everybody. What you tend to notice at private golf clubs is there's a lot of professionals there. There's a lot of lawyers, doctors. There's a ton of asset managers, real estate agents. That not everybody. Of course, there's all walks of life, teachers. Golf isn't overly expensive, but there is an upfront payment there. But yes, you can buy yourself into that good room. And the great thing about golf is, let's say you joined a supercar club. I mean, how are you actually going to get some time with those other people that you want to speak to? You still have to do some work to try to corner them and get some time with them. But when you're talking about golf, you're basically trapped on a golf course for 4 hours with these people, and you're going to get a lot of time talking to some pretty successful people. I'll give you an example. Last week, I played at Dubai here. And I was just randomly paired up. Sometimes I just go to the course by myself, just pair up with 3 other members and see who you get, right? That's the whole point of networking. And I was paired with what turned out to be, I think, about 2 or 3 people down from the CEO of Samsung. So he was like the regional CEO of Samsung. Really nice guy. I was actually riding in the cart with him. So for 4 hours, we're chatting back and forth. We became friends. We exchanged numbers at the end of it. This is kind of what can happen to you if you put yourself in that room, right? It's very difficult for just the regular people. You're not going to go to the gym and meet a bunch of successful entrepreneurs and get connections in life that way. But I do want to invite people to consider golf as that thing. So another example I can give you, more back to my professional golfing days, I started when I was 15 years old. I was pretty late in life, but I played from 15 to 24, and then I turned professional. And I was a member at a private golf club. And what I did to turn professional, because of course it's very expensive, and I didn't have any money. I'm a struggling golfer, right? So what I needed was cash. I needed people to give me money so I could turn professional. So what I did was I sold shares in myself as if it was a company, right? So for $1,000, you can buy 1 share of me, and it's profit sharing, 50-50. Whatever I make, you get half of it. That's how we did it. And golf's pretty expensive, so you need, at the time, I don't know what it is now, it's probably way more, but at the time I needed about $50,000 a year. So I raised through the golf course and all these connections that I made. I was able, because I had those connections, I was able to have meetings with these people, 100, 200 meetings or something. And I sold enough shares that I gathered about $250,000 of shares in myself. And I turned professional. I played golf for 5 years. That's not possible if I don't have the connections. So obviously golf, not only is it just fun and challenging and just enjoyable, you can play with your wife, your kids, whatever it is, but you can also meet some really good contacts. So I do want to remind people that, some people, it's not a sport. I don't get offended when people say, oh, golf's not a sport. It's not a sport, it's a game, but it's a game that can serve your life very well. So that's why this is a segment in Lessons of the Links. Don't overlook the power of joining a golf club, starting to play the club events, starting to go to these mixed events, take your wife, whatever, they'll love it. I know they will. And you can meet some good people, and it might actually lead to something really good. Because I don't know about you guys, because I retired in 2005 and then I moved to Taiwan. And for 7 years, I traded full time, and then I started my business in 2012. If I were to try to raise money in 2012 in Taiwan, I would have probably raised $0. I didn't know anybody. I didn't have any connections. At that time, I had moved away from Canada for so long that I had lost touch with people. If I wanted to raise money in 2005 or 2000, I can raise as much as I need because I've got those connections. Without golf, disconnected from that group, I was nothing. So I have that feeling why these people are emailing me. They're like, life is hard. How do I see that. I understand that your network is your net worth, but how do I get into that group? Be a golfer. Start golfing. You don't have to be good. A lot of people get intimidated by it. You think you have to be good. 90% of the people I play with are terrible golfers. It doesn't matter to me. You play your own ball. You don't influence other people. As long as you can keep up, as long as you're not painfully slow, everybody will be fine playing with you. You don't have to be good. You shoot 90, you shoot 100, it's fine. Golf's really amazing for that, for networking and, getting into those really good rooms at a fairly discount rate. Now, here in Dubai, golf's actually, I consider it quite reasonably priced. It's $5,000 to join the golf club. That money's gone. It's initiation. And then you pay about $11,000 a year, US dollars, and you get access to 4 different golf courses. So it's pretty awesome. And I'm meeting people slowly. I play alone quite a bit. I play in the daytime by myself because it's 49, 50. I played last week. It was 50 degrees. So there's nobody on the golf course. I'm completely by myself. But sometimes I'll do the night golf and get paired with people. And yeah, I've met some CEOs, some entrepreneurs, some real estate agents. It's really great. So I would encourage all of you, if you're struggling with that, you want to meet better friends. Not better as in, character-wise. I just mean, connections, trying to be as PC as I can be here. But if you want to get into a better room, take up golf. Trust me. You won't regret it. And call me up, email me. We'll play together. So that's my little rant. I will always suggest golf as something that, even though it didn't work out for me, I didn't actually make the PGA Tour. I got close. I missed my card 1 year, conditional card, by a couple strokes. So I got close, but I'd never made it. But those lessons, being a pro golfer, all those years, the discipline, the sacrifice, all those lessons carry forward. So golf has been hugely instrumental in my life, and I hope all of you start playing golf. Like my wife, she started last year, and now she's a hooked, addicted golfer. Pretty cool stuff. All right, let's get to some of these questions. That one has me curious. Somebody just rapid fire a bunch of questions, so let's get to that. I just joined the monthly subscription. Welcome. Yep, I recognize the name. How can I switch or upgrade to the 20% annual discount? Should I unsubscribe first? This is kind of a personal question, but go ahead and email me. The system is basically the same. Anybody watching, there is always a 20% discount for annual subscriptions. And all you have to do is just either cancel it yourself or just email me. I will cancel your monthly. I will refund the previous month so that you're all squared away and you actually make a little money that way. And then you sign up for the annual and you get a 20% discount. So go ahead and email me. I will remember this name and I will email you how to do this. But yes, for all VTS members, there's always an annual available. How do you calculate the equity curve performance charts compared with S&P 500, for example, for Iron Condor? Do you use trade close column? Do you track daily option settlements? Okay, so this is a good question. Essentially what I do, two different ways. So for the ETF strategies, defensive, tactical, and strategic, these are ETFs only. These are very easy to calculate end of month prices. I just mark it at the end of the month. Anything that happened during that month gets recorded as the performance. For the option strategies, Iron Condors and the volatility trend, for this one, say, this broken wing VXX butterfly, for this one, this will expire in July. So this will be counted in July regardless of what happens. But you can see the Iron Condor we have open, Qs expiring in September. Now this might close out sooner, but it might also be delayed through July. So for these two option strategies, I actually just use official realized gains essentially for options, because marking it is a little bit difficult. I could use a mid price of some sort, but it's not always an exact number. So I always find it better to just use realized gains and losses for options and then ETF pricing for the other three. So, I mean, none of our options get held open for very long, so this isn't something that really comes up often. But there are times when something is open, it goes through the month, and it gets marked basically the next month. But that's how I do it. It's very easy to calculate performance. I mean, especially lately, the defensive rotation strategy, we have actually held this since March. So pretty easy to calculate performance on the Qs. It's raging higher, and that strategy is doing extremely well. The last time I calculated performance for that defensive rotation strategy, I think it was up like 58% so far this year. So it's been fun. We have not had to do anything, completely hands off, but that's how I do it. Super easy to track performance. Audio's good, audio's good. All your entry exit signals are based on the volatility barometer percentile rank value. No, but I will continue reading. If so, from what rolling window, 1 or 3 year? So good question. Not everything is on the barometer. So the only strategy we have that is directly the barometer level is the strategic tail risk. This dial pointing to those numbers is quite literally exactly pointing to this number. So any one of those sections, it is pointing there. That's the strategic tail risk, directly from the barometer. Everything else has influence from the barometer, but the defensive rotation, even though sometimes the dial points in a similar direction, because of course there's correlation among all of the volatility metrics, this one actually uses a different combination of the metrics. So the defensive rotation isn't using just the barometer, it's using influence from several of the other ones. And then the tactical volatility strategy is also using different volatility metrics. Entries and exits should not all be determined by the same metric, because then diversification is lacking in that case. So in the interest of having different signals for different strategies, we do have, defensive has its own little barometer, so to speak, its own set of 4 or 5 values. Tactical volatility uses the three most popular, most common ones. And, or I shouldn't say common, I should say most useful. And yes, the strategic tail risk uses it directly. So as far as your last question, what rolling period? These are all based on a total rolling period since January 1st, 2011 on the barometer, and July 17th, 2006 on everything else. Numbers or those dates might seem a little odd, but July 17th, 2006 is when a lot of the volatility data becomes available, robustly across the board. And January 1st, 2011 is when every metric within the volatility barometer has its own 5-year window that I can look at. So that's when the barometer becomes robust enough to use, essentially. So it's just a rolling period from the first point where I've determined that the data is robust enough to start using. Let's say there's a volatility metric that gets released tomorrow, a brand new one, or Monday. I wouldn't use it right away because, of course, if you're ranking percentiles, everything's going to look like 100% or 0%, and then it's going to phase through over time. I use everything based on rolling percentiles, so I need about 5 years of data before I can even start using something. So that's why those dates, they might sound a little odd, but that's where they're coming from. So technically speaking, this is a good question. Technically, only strategic tail risk is using the barometer directly, but all 5 of them are using a combination of about 20 different volatility metrics. And different. Defensive is using different metrics than tactical volatility. They shouldn't use the same ones. We want to be diversified. All right, so here goes. Uncommon sense. There's a lot of these, so hopefully it's not a hater. We had one of those a while ago. He's just rapid fire, just can't stand me for some reason, but still found the time to tune into my live stream miraculously. So I don't understand that hate watching thing myself, but here we go. Uncommon. I'm sure you're not a hater. Okay. I noticed some of your TOS videos that you utilize an indicator called VTS term structure. Can you confirm if this indicator tracks the real-time VIX futures? It does, but I don't really use it. I use everything in my spreadsheet. So you might have caught a glimpse of something when I was showing my TOS charts, but that live term structure, that's basically the M1, M2 roll yield, I don't really look at it. I'm kind of an old school guy. I do most of my work in Excel still. That's probably what you saw. No, it's programmed in there. Like I have somebody wrote a script for me and sent it to me because I don't really have any programming skills, but I don't use that. All right. I share your preference for maintaining control over your data and not being at the mercy of third-party data providers. Continued. I would like to use this indicator in TOS so that I have access to real-time term structure data without relying on VIX Central. Well, it is coming from the SIBO, right? So you were always, doesn't matter where you're getting your data, at some point it's coming from a data source. So I can't really speak on which one is best, which one is unreliable. Just go with the big ones. Whatever TOS shows you, chances are good that it's accurate, right? I've never had an issue with TOS. Aside from the odd time you might be looking at the VIX and you see these crazy bounces and you think, oh my God, the VIX went from 18 to 11 in 1 second. It didn't. It's just a bad print. But no, TOS is exceptional. And like I showed in that live VXX trade, I completely trust even the mid price. When it says the natural, the bid, the ask, the mid, something like Interactive Brokers, which my long-term portfolio, I do use Interactive Brokers for all my capital, except the live stream account. I should actually make that clear. This is just money that we can trade in the live stream, and I don't have to hide account values and account numbers. I think you can even see the account number right on the live stream. Yeah, I don't really care about this account too much. I use Interactive Brokers, but when I'm trading, I don't trust the bid-ask spreads. They're not actually that accurate. And when it has a mid price, it's not really overly accurate. TOS is exceptional. So what I do is I open Interactive Brokers and TOS side by side. I do all my analysis here. I'll check everything. I'll analyze my trades, do all of this in here. And then when it's time to execute the trade, I will go into the analyze and I will look to see what is happening here, right? So I will build a trade and I will see, okay, 38 cents. That's actually quite accurate. And then if I want to actually execute the trade, it'll give me a good mid price as well. So I would say it does sound like you're using TOS. I would say that you can basically trust it all. You can trust VIX Central. I've never had an issue with there. So you said you don't want to rely on VIX Central. There was only one time that I remember, and when it happened, I immediately on Twitter, I let the guy know that there's a data problem there. And he fixed it up that morning. So I would just say you have to trust data. If something seems odd to you or out of place, of course, double check. But it's very rare that something is flagging. Now, I wouldn't say the same for some of the other things. Like I don't know about Robinhood or any of those other bargain brokers that don't charge any money. I don't know, but TOS, Interactive Brokers, these big ones, Tastyworks, go ahead and trust the data. You mentioned that you don't code. No, unfortunately, I don't. Who developed it? So it seems that the question is, where do you get that script? Essentially, I don't want to get into it because I didn't write it. Somebody sent it to me, and I don't even think I have it anymore. But I don't think it's overly useful. It was just a sort of a slightly more visually appealing term structure. That's all it was. But you could just get the exact same thing. You just go to VIX Central. This is accurate. This is, I mean, of course, there's time delayed a little bit, I think, delayed probably for He probably says it's 15 minutes delayed, but it's probably only 5 minutes delayed. Yeah, I don't see any reason why you can't trust this. I've never had an issue. So, knock wood. If not, what other factors do you consider? Okay. Is the reason for VTS's better live performance compared to its backtested results due to the use of intraday data for trade signals instead of waiting for the closing prices? So this is an interesting question, and this is where, again, I want to choose my words very carefully because we have a very large community with a large number of subscribers, and everybody's different. Everybody's performance is going to be different because, of course, markets are open for, there's a 6.5 hour window, but there's a 4 hour window between when I send my email until the markets close. I like to give people a lot of time to execute their trades. Now, there are times when, let's say we're holding the 2 times NASDAQ, for example. We're holding our defensive rotation strategy. It is not hard to imagine that in that 4 hour window, the QLD can actually move a lot. If you take a year like 2022, there were days where from noon until close, it was either up or down 10%. That can happen. It's not common. I don't want to make this point that, wow, it's just the wild, wild west. It's not. But there are times when performance can deviate. So again, this is why I want to choose my words. Recently, the performance for the tracking of the portfolio is a little better than my spreadsheets. And that's been true for the last, say, couple years. Because I use performance based on live fill prices from that TOS account. And I execute those typically about within an hour and a half, depending if I get busy or something right after I send my email or if I have to do a live stream. But typically about an hour and a half after the email, sometimes closer to 20 minutes, sometimes an hour and a half. But you can imagine what would happen in a year like 2022. My spreadsheet is waiting for the end of day prices. And in a really bad year for the stock market like 2022, luck of the draw, probably executing trades at around noon or 1 o'clock, the performance was better. It just happened to be because it's a really bad year. What makes a bad year a bad year? Well, in one case, it's that the market tends to sell off into the close in really bad years. What makes a good year a good year? Well, there doesn't mean there's not bad days, but there are more recovery days where it kind of swings up afterwards. And end of day might actually be better in a good year for the stock market. So it's all randomness, right? That 4 hour window, you can never know. I have no data showing that end of day is better or worse than anything else. My spreadsheet has to use end of day because I do a lot of post-trade analysis on everything that I'm doing, and it just makes sense to do end-of-day pricing because everything matches up. I can go back and I can confirm data. We have no intraday values for anything, right? That's basically what I'm saying. But when you're executing live trades, I have noticed that my live performance is slightly better than the spreadsheet because the spreadsheet is using end-of-day. That can totally flip. So according to your question, from say 2012 to 2020, that was not the case. In the last 2.5 years or so, give or take, it is the case. It's randomness, right? I don't put much thought in that. I always go with the theory that over a large number of transactions, it's all going to work out the same. Some days it would have been better to go at noon. Some days it would have been better to go late in the day. I don't want to put anything on the line because there's no data to support any of that. It's just randomness. It will work out all the same on a long number of transactions. Okay, you're still going. If not, you're going crazy with these questions. What other factors do you think contribute to the better live performance? Well, there's a lot of factors why my performance is good. I don't want to go into it all here. That would be an incredibly long rant. Maybe I should put it together in a more organized video, like a top 5 reasons why I feel like my performance, why it's so good for so long. I think one of the things, I won't just punt completely on the question. I'll give you one. I'm not going to give you 5, but I'll give you one. Just the nimbleness of what I do. That people radically overestimate this, but everybody kind of knows. It's kind of a weird thing, to be honest. I was thinking about it recently. Somebody was posting on Twitter, and they're the volatility fund manager, so to speak. And they seem to get a lot of awe and attention. Like when somebody on Twitter is a volatility asset manager, people tend to, suck up to the guy. They think, oh my God, he's so good. He's so smart. He's a volatility expert. It's kind of a weird thing because we all know, pretty much everybody out there knows that 90% of those asset managers underperform their benchmark consistently, right? So we can say that the vast majority of asset managers are not worth a penny, right? But when they're tweeting, for some reason, people forget that statistically speaking, you're probably looking at tweets from somebody who's terrible at their job. But there's this breakdown where people think asset manager, they think, okay, this guy's an expert. He knows what he's doing. His tweets sound incredibly smart. If you saw their performance, you'd probably think otherwise. You'd probably unfollow them immediately, right? The vast majority of the performance is terrible. And so getting back to the one thing that I will give you about the nimbleness of my portfolio and why I crush all of these people, it isn't necessarily that I'm better at it. It's like I want to give myself some credit that, yes, I've been doing this for 17 years and I'm very experienced in all of this. But that's not all of it, right? Some of it is the fact that all of those asset managers are in some way handcuffed to invest in a certain way, and they can't do certain things even though they know that's what they should be doing, right? So for example, a hedge fund has to stick within the guidelines of their mandate. So if something comes up, they kind of just have to ride through it. Asset managers, financial advisors, all these people, they can't just tell all their clients to sell everything and move to cash. They don't get paid if they do that. So they're all handcuffed in some way. So when I criticize the financial industry and I say the performance, 90% of them are garbage and you shouldn't pay a penny to them, I'm not actually being disparaging to the person's ability or skill necessarily. It is entirely possible that that person who has a terrible track record with their client money is pretty knowledgeable on the side with their own capital, right? But they can't do what they do with their own capital with a community of, or a list of clients, or staying within a mandate, or, abiding by the laws and regulations and compliance officers that are looking over your shoulder. There's a lot of things they can't do. So one of, say, 10 reasons why VTS performance is so good I would say it comes down to the fact that all you're doing when you follow VTS is you are following me. You are following my portfolio. This is where my money is. And if I get a signal from the market that it is no longer a good idea to be in 2 times equities, right? If volatility jumps from where it is now up until about 55 or 60%, I can just exit on Monday and I'm out. And I'm in utilities. And if it gets any worse, I'm out again and I'm in cash. I'm super nimble. I do what I want. I do what's best for my money 100% of the time. But when you're talking about all these asset managers, again, I'm not being disparaging to them personally. I'm sure many of them are good investors. I'm sure many of them can manage their own capital and their wife's capital effectively. Great. But that's not what the clients are following, is it? The clients are subject to what the asset manager is allowed to do. And unfortunately, almost across the board, it's garbage. They are handcuffed in some way. So there's one reason why I believe my performance is just significantly better, and I suspect it always will be, just simply because I'm not like them. The structure that I have chosen to do this from, I'm not like them. I don't have to hold on to something even though I'm like, oh man, I really should sell that, or I should buy some options to overlay some type of hedge here, but my compliance officer doesn't like when I trade options, so he doesn't allow me to do the options. All kinds of things come up. A hedge fund manager's like, I see headwinds in the market. I would like to pivot, but I can't because I've got a mandate here and I have to stick to the mandate. All kinds of reasons why sometimes they just have to watch it go off a cliff, and they know better, but they can't really make those short-term pivots. And I can do it in one day. I can cycle out of my entire portfolio today on Friday, which we are quite strongly net long equities and have been for several months. By next Tuesday, I could be in full safety positions or even long volatility and hedged in one day. right? This is a clear advantage that I have over my competition. So that's what I would say is two things. One, nimbleness is super, super important. You don't ever want to just have to stick to the status quo because, well, that's what compliance allows me to do. And the second thing is, don't ever forget that the people you're actually watching online, don't forget that a substantially high percentage of them aren't actually getting good performance. So don't be enamored by the fund manager, volatility guys. Sounds cool on Twitter, but their clients are not actually that pleased. Again, not always because of the person. That person might actually trade on the side. They might be pretty decent, but now I'll put together something, maybe a 5-part video series, trying to articulate why I think that what I do is better and why I think my performance has been and will continue to be better. Interesting. I'm actually gonna, where's your question there? We'll just save that one for later. All right, one more from you, and then that'll be it. Yes, that is it. I got to get to other people. Can you please explain how you normalized your data from 2006, even though the VIX 90 is not available? I have data for much longer than you probably do. Not that I'm super special or anything. I have deliberately made an attempt to get data as far back as I can go. I've contacted all the people that are basically managing the products, and they have maybe influenced slightly by the fact that I have a public exposure, but I do have data for as far back as they go. But publicly, they typically don't release things like that. I think you're right. I think the VIX 90, while I have it going back further, I think publicly maybe you might only get it to 2011. There's some of these things like that. The VVIX, for example, you probably can't get that. VIX 3M, 6M. But again, I'm not trying to say I'm special, but I have data longer than you do, probably. That's why July 17th, 2006 is a fairly important cutoff date. VIX 3M, 6M, hint, hint. Okay. Does the stock price adjustment that happens on X dividend day happen as a result of supply and demand? Lots of people buy to collect dividend. No, I would say that that's a mistake. I think that dividend... I'll finish your question first. Do brokers, market makers actually adjust the stock price just like how we adjust our clocks? The exchanges adjust the stock prices. You have to understand, there's a lot of misconceptions about dividend investing. People actually think that when they get paid a dividend, I got to be careful not to go off on a huge rant here because it's something that bothers me. But when people get paid a dividend, for some reason, they feel like they've made money. But what has actually happened in real time is net zero transaction. Your portfolio has not increased in value even 1 penny on dividend day. What ends up happening is the company disperses cash, and of course now the company is poorer because of it. They didn't create this money. They don't have a money printing machine. They distribute money from their company, right? So the company is slightly weaker after dividend day. And so of course the exchange adjusts the stock price down to reflect the dividend that's paid, but you get the dividend, so your stock value goes back up. So all that happens in your account is you go from holding equity, let's say at 100%, now you're holding equity at 99%, and you're holding literal cash at 1%. You are made whole. So you didn't make or lose anything on dividend day, but you didn't make money. That's the key here, is that dividend investing, you should never invest in a company that has anything to do with dividends. I mean, if they pay dividends, fine, but it's not free money. There's this idea that you just, I just buy nothing but dividend stocks because it's passive income. No, it's not. If you buy a stock that doesn't pay a dividend and you just decided next Wednesday, I'm going to sell 1 share of that company, that is materially identical to what happens when a dividend gets paid. All you're doing is selling stock and you're getting cash in exchange for the stock. That's what a dividend payout is. So to answer your question, the exchanges adjust the stock price down. You can see it much easier. The reason a lot of people don't know this is because dividends are extremely small. They're typically quarterly, and it's a very, very tiny part, so people can't even see it happening, right? But if you go to a special dividend, you can see it. You can see big shock moves on that special dividend. Yes, of course, the company can't give out all this cash and then be valued at the same the next day. Its stock price has to be adjusted, of course. So that's what's happening. It's not people, it's not by supply and demand. Now, what you're getting at here with this question, there is some research that shows on both sides of this that surrounding a dividend date, there might be additional exposure. There might be people buying the stock in anticipation of a dividend coming. So maybe there's a little bit of an additional run up. And after the dividend is paid out, maybe the stock is slightly higher valued because of that supply and demand. But there's also evidence to show that the opposite is true. There's also evidence to show, I mean, of course, statistics, you can get them to show pretty much anything. So I would say the jury is strongly out on this one. I don't think that there's any strong reason to believe that dividend stocks maintain any of that buying enthusiasm around the dividends. I think that big money kind of knows what the deal is, and markets tend to be pretty efficient. So I would just assume it's a net zero transaction and nothing is actually happening. Dividends are something that just makes people online go crazy. They just love their dividends. They think that they're getting all this free money and I'm just sitting here and the company's paying me to own it. Yeah, welcome to stock trading. That's literally true on every single security in the world. It's identical, right? You're not special because it's called a dividend. Some companies don't pay dividends. They use that retained earnings in a different way. Maybe they do R&D development. Maybe they buy other companies with it. Maybe they just keep it on hand to try to buy back their own stock later on. There's many, many ways that companies use their retained earnings. Some companies choose to just throw it out in a dividend. It's not wrong, but it's not better than the other reasons. They're all kind of advantages and disadvantages. So yeah, dividends are a non-issue. Consider it that. It's nothing. It's not passive income. It's not free cash. It's nothing. It's just a number adjustment in your account. Nothing has actually changed. So yes, I'm still on. Good. Hopefully I didn't crash there. How long have we been going? I do like to cap these. Would love to hear thoughts on ZIVB. I know you've been emailing me, and my email inbox is an absolute nightmare lately. I apologize. I did not get back to you on your email. But I will do a full ZIV presentation. It's been trading for a little while now. It used to be my favorite product way back in the day. It's been quite a few years since I've said that because there are reasons to believe that the midterm futures are not as good as they used to be. But yeah, I will absolutely. Let's go ahead and save that one for later too. All right, Uncommon Sense is back. Could you please clarify if the barometer will switch from holding QLD to VGLT or XLU based on the closing prices instead of using intraday? Intraday. So essentially what I do is every morning, well, not morning for me, I'm in Dubai, but so I'll wait about an hour after the market's open, and then I will input all of my data in my spreadsheet. So, I mean, of course, I will go across the board, I will input all this data, and then I will go to the volatility data and I will input all of this data. It might look like a lot. These are a lot of data points, but I will go through it, and it might take me 20 minutes, half an hour to go through all that. And then it'll spit out basically what the trades are. So defensive rotation, oh, no, I don't want to do anything stupid here. But yeah, like my strategies are all designed based on the data that I'm collecting every morning, right? That's how this works. And then it will automatically spit out the trade, right? This is for the defensive rotation. So I know on that day, of course, it tells me to do QLD. So all of my data inputs are there to essentially get the answers to what my positions are going to be for the day. Tactical volatility will be the same. Strategic tail risk will be the same. These are big spreadsheets with a lot of data inputs, but essentially it narrows it down to 5 trade signals. And then around 10:30 or 10:45, I'll start preparing my email. And those trade signals are based on data input from 1 hour after the markets open. Okay? So you could say that all of my trade signals are based on intraday data roughly 1 hour after the markets open. So when you look at the barometer, when you look at all the data that we do, the trade signals, it's not end of day. But then what I will do, and this part sometimes confuses people, is at the end of the day, do the whole thing again. Input all the data with the official closing prices at the end of the day. So I do this twice a day. And those are the numbers that I keep for myself so that I can be analytical with my strategies and make changes if I need to. And that's what my internal data is based on, the end of day prices. But the trade signal is based on intraday, 1 hour after markets open. The only reason I don't do it sooner is because that first hour can be pretty choppy. You can get some bad volatility prints in the first hour. A lot of the day traders are doing their thing in the first hour. So we'll give it to the day traders, and an hour after markets open, things settle down. I get the trade signals, send them out to the community, and then you've got 4 to 4.5 hours to execute your trade. That's essentially how it is done. So is it, oh yeah, you're not asking me, is it actually going to go to VGLT? Yeah, end of day. Sorry to harp on this further, but could you please clarify if the barometer will switch? Oh, you already asked that. I can imagine that may take a long-term difference in performance. No, you'd be surprised. Like one day, I always say intraday data is noise. Like I said, you have to make the assumption that there is no advantage or disadvantage to that 4-hour period. If you're going to get so hyper-specific on your trading that you actually think that 4 hours of intraday noise is going to dramatically change the performance, then it's going to be difficult for you to pull the plug on any trades. You're going to be so handcuffed, because this is the thing about investing. You have to pull the trigger. You have to actually, I always do golf analogies in all of my live streams, and I haven't done one yet. So here you go. Here's your golf analogy. When you're golfing, one of the thing that separates a professional, like I used to be, like I'm not anymore, but I used to be, from just the regular amateurs is I'm extremely regimented on my pre-shot routine. So if you watch me, it is timed down to the exact second, the mannerisms. Every time you see me, I'll stand behind the ball. I'll do 2 of these very slow practice swings. I will visualize my shot. I will see it going, up and then down. I'll see the exact ball flight. I'll pick up my shoulder like this so my shirt doesn't hook on me. It's just something I've always done. My left-hand glove, I tug it a little bit. It's exactly the same. It's 11 seconds from when I go from the back of the ball right up to the ball. 2 looks, go. It's the same. You have to pull the trigger when you're golfing. If you start thinking about everything else that you can't control, you can see it sometimes in these players on tour. They get so wrapped up in a ball that they can't pull the trigger anymore. And I've had that experience before. Right around 2004, I had about a 6-month stretch where I slowed way down in my golf. And what was happening is my brain was so overworked on things that at the end of the day, I just can't control those things. But I was thinking about them constantly. Like, okay, now the wind is up. Well, if I wait 3 seconds, is the wind going to calm down? Well, that person over there, I can hear what they're saying. The person in the gallery, they're talking. Maybe if I wait 4 seconds, they're going to stop. And your brain's just a ball of mush and you can't even hit the ball. You have to pull the trigger. Trading is the same thing. It is so important to, as I always say on the live streams, control your controllables and forget the rest. It's noise. Let's say 3 hours later, the price might be better. Well, that's not information that I can use. There's nothing I can do with that. So you got to pull the trigger. And long-term data, when I go back and I run the numbers between my portfolio live trading versus my portfolio as it exists in those spreadsheets, it's very close. Very, very close. Some years it's better than others. Some years it's worse than others, but it's very close. You can't control any of this stuff. It's just noise. So pull the trigger. I don't want you to get bogged down on things that you're going on this line of questioning, and I can see you're giving it too much thought. I would say you got to forget about it. Assume it's 50-50. Some days it'll be better. Some days it'll be worse. Just accept it. It's 50-50 and move on. We all have to trade. Is there any daily? Again, same question. No. Just assume no. Just forget it. I understand that questions need to be asked and you should analyze things, but I've thought about these things and looked at the numbers for 17 years now. I've been doing this. No, there is no advantage to thinking about intraday noise. Really, we're not getting hung up on that little minutia. We got to pull the trigger on our trades. I stopped out of the Q's iron condors before even receiving the email. Should I reestablish? I mean, the market was up, but it's not up that much. How could you have stopped out? What's it trading at? Let's just double check this. 153. It's not even close to stopping out. Boy, I don't know. You're going to have to email me. It's not that far away. The Qs were up quite a bit in the last 2 days, but no, we've still got a comfortable margin there. Well, that was weird. Were you staring at my screen the entire time I was doing that rant? I don't know. Yeah, you said you stopped out of the trade. You shouldn't have stopped out. So definitely email me. I'm going to drop my email just in case you don't know it. You probably do if you're getting my daily emails. But yeah, go ahead and email me. And we got to figure out what your entry price was, because, or you could be the subject of a data problem here. It might be showing you that, oh, wow, I have stopped out, but you're actually not even close, because we've still got at least 13, 14 cents there of room. I'm not concerned about what price I trade in the day. I just want to know if the signal would be different. Sometimes. Yeah, absolutely. The signal might be different sometimes. Like I said, especially in a year where something crazy is happening, like a super S&P up 30% year, 2022, the S&P crashing down, whatever it was during COVID, for example. You can imagine that there's going to be a lot of intraday swings. And if you look, this is another thing that you learn the more that you do this and the more that you're a tactical investor. There is quite literally a 2 decimal point threshold right there at that threshold, right there at that threshold. We are down to Volatility Barometer. Where's my number? These numbers are like 29.86. On the strategic tail risk, 55.01 changes position. 55 doesn't, right? 83.01 changes position. 83 doesn't. You can understand that if there's intraday movement, some of these signals would be different from when I send the email until the time markets close. But of course, there's 2 things. Number 1, it doesn't matter long term, so we just throw it out, right? This is another golf analogy, but when I was playing well, I called it my bubble. I live inside my bubble. I walk down the fairways in my bubble. Everything is inside my bubble, and I'm constantly noticing things. If there's something that's bothering me and in my brain that I can control, I put it in my bubble and I solve the problem. If it's out of my control, I throw it out of my bubble. And I've actually told this story before, but there were times when I was really focused on the course and really playing my best. Sometimes people would see me like doing stuff like this, like physically, man. The sports psychologist actually tells you sometimes to physically act it out. So I'm throwing things out of this imaginary bubble as I'm standing on the green waiting to putt. Sometimes people notice those things, but so that's number 1. That's out of your bubble. You can't control it anyway. Number 2, if I did use end of day, then there's nobody in the community that could follow the signal. So of course I have to give people enough time to actually execute their trades. And since none of it matters, what I used to do is send it right at 12 noon. And now I've noticed that in my data, nothing really matters. There are days when it's a different signal, but then 2 weeks later, it's a different signal the other way, and it kind of bounces back. It's 50-50. But yeah, I just keep going earlier and earlier because my data shows that it's really just random noise. It doesn't matter. So these days, I'm tending to send my email around 11:20, 11:15 sometimes. Yeah, even 11 o'clock. Doesn't matter. But the few people in the comments that are asking these questions, this line of questioning, believe me, I went down that rabbit hole for years. So I understand why you're asking these questions. It's new to you. It's not new to me. So that's what I don't mean to sound condescending, like, oh, don't worry about anything. It's valid. Like, your questions are valid, but take it from somebody who has crunched the numbers for, almost 2 decades now. You've got to just control your controllables and forget the rest. All right. Typo is morning, more volatile than noon for signals. Yeah, I would say early morning is more volatile for signals. For the first, say, 30 minutes, it's not very reliable. So that's why I wait an hour. Question. Given positive drift, is it better to buy SVIX at market price at any given day or wait for reversion towards the mean? Moving average. What are you asking? Is the answer as obvious as I think it is? So, okay, so I think what you're trying to get at is because there is long-term positive performance, should you just enter immediately? If I'm wrong on interpreting this question, forgive me, but there's a lot of people who say the old saying, time in the market beats timing the market. Is that kind of what you're getting at with the volatility space? Because technically speaking, if you just buy the SVIX and you just do this and come back 20 years later, there's a decent chance you would have made a good amount of money. But that's a terrible idea, because it's one of those things where, and I'll get into it in the course. Remember, we're doing a full video course on this strategy. One of the reasons why volatility trading on the ETFs, SVXY, SVIX, VXX, UVXY, one of the reasons why it can be so profitable is because the underlying is so volatile. And so what you can essentially do is, if you're trying to, I'm going to trade 20-year US treasuries, I'm going to use the TLT, and I'm going to try to improve the performance of the TLT by being a tactical investor. It's actually very difficult to do. Probably holding the TLT is going to be better than any tactical strategy you can design, because the movements are quite small, and it's actually time in the market is just better than timing the market, right? So just hold the TLT. It doesn't have the volatility to trim and go for the low-hanging fruit. But something like the SVIX has insane crashes that with just a little bit of entry-level knowledge, you cannot ride that whole thing down. And it has really good uptrends that with a little bit of understanding of how the product works with the VX30 roll yield, you can actually buy it at the right time. So for TLT, or for any, even maybe the S&P 500, but not really, because it does crash 50% sometimes. But for anything that's reasonably stable, yes, just buy it and hold it. Buy and hold will probably outperform any of the things that you're messing around with in your strategies. But for something like volatility, that is totally not the case. You definitely want to try to time the volatility markets, and it is very possible to do. I've been doing it for well over a decade. I always laugh when people say, oh, you can't time the market. Okay, but I've got actual money that pays the rent that says that you can. So I don't know what you're talking about. Of course you can time the market, but you have to look at the right underlying security. Very difficult to time the TLT or the IEF or bonds or even gold. It's very hard to time these things. I would agree that buy and hold is largely a good idea in really boring, stupid assets that we don't ever touch anyway. But for volatility, yes, you don't just buy it and to say, well, 20 years later, it'll be positive. We're trying to cut off those low-hanging fruit periods where I don't want to ride the drawdown 92% like it did in 2018. I don't want to ride that 92%. I'm good riding at, say, 30 or 40. That's part of the trading process, but I'm not riding at 90. And so uptrends as well. It's pretty easy to catch these uptrends. I mean, the signals are fairly easy to understand. And if you don't understand them, again, shameless plug, but join the VTS community, and it's not going to take you very long before you start understanding these things and you start realizing, oh, wow, you really can time the market with volatility related. Like I said, bonds, good luck. But yeah, timing the SVIX is not difficult to make a long-term outperformance return. I've been doing it for a very, very long time. So no, don't just buy it at any price because it's better now than it eventually is. You want to be tactical with your volatility trading for sure. Do you stop out of trades in real time or wait for out? Okay, good question here again. Again, everything is done on that same time frame. The trades are sent out, so I will not only input all the data from my spreadsheet for about an hour after markets open, and I'll send the daily trade signals, but that also applies to the option trades. I will check every open position on the option trades. I'll see if it stopped out or not for the gain or the loss, and everything is going based on my trades. So while you are free, if you want, you have an entry price, and you know that it's a 50% stop loss. So if you want, once you get the entry from me, you can set your own stop loss and you can exit when your trade exits. But I just always feel like it's probably a little better, and I can't directly tell you to do this, but I think it's probably better if you just enter and exit the trades on the same day that I do, even if it might not completely align with your pricing. Say I sell an iron condor for $1.20, my stop is $1.80. Let's say you unfortunately did it at a different time of day. Or let's give you a better price. Sounds better. Let's give you $1.30, right? Your 50% is 65 cents. You're at $1.95, right? You might stop out at a different time than me, but I would still say long term, it's not going to matter. Some days it's going to be better. Some days it's going to be worse. It's the whole 50-50 random noise again. I would say enter and exit when I give the signals. And those signals are all based on roughly 1 hour after markets open, including the options for stop losses. Bruce Lee used to imagine crunching up worries like a piece of paper, not getting caught up in worries you can't control. I like that. All these little mental things. This is why I'm so grateful, even though my golf career failed, ultimately, I didn't make the PGA Tour. I just learned so many valuable things. So for me, sometimes people ask me questions and that's just unimportant. Just don't even worry about it. For me, I've had decades of training, of actual mental training to be able to do that. I understand it's not easy. Plus, I have a great track record of trading for so many years that I can confidently say that doesn't matter. That matters. That you need to worry about. That you don't need to worry about. I've gone through all this routine. So I don't mean to sound flippant when I say, oh, all questions are valid questions and I will answer everything. But I will tell you the truth. When I believe something truly doesn't matter, I will try to get you to forget about it. Otherwise, you're just going to be a wreck. There are people who can't trade. They just can't. There are even people who have a real extensive knowledge base about trading, lots of experience, and they can't trade. I've heard of traders out there who design systems and then give them to other people with access to their portfolio so that that person makes the trades, because they can't do it. When the trade signal comes up in their spreadsheet and it says, you're supposed to be in this position, their brain is mush. They think about too many things and they can't pull the trigger. So they need a third party to execute their effective strategy for them because they can't do it. You don't want to be one of those people. You want to be somebody who can, as I always complained on the golf course, why is this guy having his caddy read his putt for him? What are you doing? We all started at the same place. When we were 15 years old, we didn't have caddies. When we were playing the national tournaments in college, we didn't have caddies. We grew up doing everything ourselves, and now you're a professional, and now you get somebody else to read your putts for you? What's going on? That doesn't make any sense. I mean, you can be a partnership maybe, but I see people literally, they get so wound up in themselves, they can't do anything on their own. You don't want to be one of those people. So trading is, it seems like all math-based, all quant-based. It's really not. There's a very high element of emotions involved. And take my word for it, you can wind yourself up pretty good. So yeah, I like that. And I mean, who can argue with the late, great Bruce Lee? Could you please explain rebalancing of VXX and UVXY? Try to make a correlation between ES and VIX futures M1, M2. I want to improve my timing and forecasting. Well, the rebalancing is utterly simple. I don't mean like, wow, you didn't know that. I should choose my words more carefully. It's a very simple process that, again, doesn't matter. So at the end of the day, the ETF basically has a certain pool of capital, right? And they are holding a certain percentage of M1 and M2 futures. And at the end of the day, they need to rebalance by trimming a little bit of the M1s and moving a little bit of that capital towards the M2s in alliance with their mandate, right? For the SVIX, for example, a -1 inverse product, they have to actually buy the VIX futures to balance everything out at the end of the day. They have to buy those future products to basically bring it back in line so that the next day it starts tracking its one-day mandate. Something like the VXX, for example. You know, if volatility spikes, it has to rebalance at the end of the day so that the next day it's maintaining its 1 times long exposure to volatility. The actual rebalancing is unimportant. The relationships between the numbers is what you should be looking at. So it's really difficult. Like, of course, inside the community, there's dozens of articles and videos that you could be reading from, but try to help you out here. So at the end of the day, we're going to sell a little, SVIX is going to sell a little bit of this and move, or VXX, whatever ticker you want, UVXY. They're going to rebalance. That's not what you should be focusing on. What you should be focusing on is The relationship between these two futures, based on how many days to expiration, so there's 4 days left. So basically what this means is the majority of the volatility ETPs are holding the M2 future. Probably, 85% of the M2 future. They're not holding much of the M1 anymore. But this relationship, let's call the VX30 right there. Hopefully you can see my little wiggling cursor here. VX30 is probably just inside that. If it hasn't changed today, I can actually tell you exactly what the VX30 is if you really care. But where's the VX30 value? So it's 1568. I don't know if the market has changed now. That seems pretty accurate. So the VX30 is at 1568, pushing pretty close to this M2 future. The relationship between that number and this number, the VIX index, this is the first thing you should dive into if you want to understand the volatility products. That is called the roll yield. So in our email, of course, you can learn all about the roll yield in some of these articles. So of course, this article, the VX30 roll yield, this is going to be an important article for you to go through. But all of these, go ahead and check out all of those. But that's the first relationship you need to understand. The volatility products only care about this. Don't worry about the actual rebalance. That is mechanical. It's based on a methodology. It's the same every day. It's very unimportant. It's only ever come up once where it was a big deal. And of course, that was Volpocalypse, but that won't happen again. For many reasons, the market is much safer now than it was back then. But don't focus on that. Focus on the relationship of the VX30 to the VIX index, and you can start to get an estimation for how these products are moving around. There is a reason why I'm able to reasonably accurately calculate where the volatility ETPs are going to be in 5 days for that trade that we just took. I kind of know that long-term historical numbers point to the VXX going from 24.25 to 23.47 in 5 trading days. How do I know that? Because I understand the relationship between the VX30 to the VIX roll yield and how that affects the volatility products. So that's what I would focus on. The rebalancing itself is done at a net zero transaction. There is no buy high, sell low. It's losing a little bit, everyday rebalancing. Nothing happens during the rebalancing. This is one of those, I don't know what you do for a living. Let's say you're an engineer. I'm not an engineer. If somebody over there who's not really an engineer, but they're trying to pretend like they're an engineer, I probably can't tell that they're faking it. But you, as the engineer, you will just pick up on certain language that you'll know immediately, oh, that person's just a fraud. They're just doing that on Twitter. They're not actually an engineer. They don't know what they're talking about. You probably know those things, right? There's certain tells. In my world of volatility, one of the most obvious tells that you're dealing with a person who claims to be a volatility product trader, but doesn't have a clue what's going on, is when they try to claim that the daily rebalancing is what's causing the changing of the price of the VXX. You'd be amazed how many people actually think, because it's selling the M1 product and it's buying the M2, and if the VIX futures are in contango, the M2 is going to be higher than the M1. You'd be amazed at how many people actually think that that's causing a slippage of capital to the net asset value. It is not. It is a net zero transaction. All you're doing, it kind of gets back to the whole dividend thing. You're not creating or destroying anything. You're just moving it from one column to another. Nothing is happening, right? Same thing with the daily rebalancing. Nothing is happening. You're just moving the same amount of capital from here over to here, and the net asset value has not changed. So rebalancing doesn't matter. They do it. They have to do it every day. They have to bring the products in line so that the next day they can start with the proper exposure. But that's not what's causing the movement to the products. The movement of the products is quite simply the movement of the VIX futures themselves. There's a whole bunch of external things that we can look at that might influence our predictions of where those VIX futures are going. But at the end of the day, the volatility products directly follow whatever the value of those VIX futures are. So right now, is it going up or down? Well, statistically speaking, 84% of the time, it's going down, right? We know the VXX is going down. We know the SVIX is going up. All else being equal, if nothing crazy happens over the weekend, next week, the VXX will be lower, SVIX will be higher. That's just what we know, but not because of the rebalancing. All right, so I got through all the questions. I went over again an hour and a half. I'm really terrible at time management. But like I said, for everybody who's still hanging out here, I'm pretty excited about the upcoming tactical volatility strategy course. I've got a rough outline here. You can kind of go through this. We're going to go through the performance spreadsheet. We've actually done one of them already. This was important to show that actually my live trading results are substantially better than the strategy that I was showing. This is the spreadsheet, basically the strategy as it exists in the spreadsheet. That's what you're looking at here. But my live results are far higher than 30%. They're actually in the mid 40s. So the first article that we did, I wanted to explain like what is going on. Why is my live performance so much better than the spreadsheet? There's reasons. So we have already started the course, but there's a bunch of stuff. We're going to go through the differences between the 0.5 and the 1 times, the long vol products, why we're using gold, all this stuff, like how it goes. Oh, stock replacement, super important. If you're a broker, for example, this is going to come up a lot. Some of you might be Europeans. You're not going to be able to access the VXX or the UVXY or any of these products. So you're going to need to use stock options. And so that's what I'm going to teach as well in the course. So again, shameless plug, but if you do want to sign up for the community, there's a free 2-week trial. You can, if you pour through that 30-part Iron Condor course, you can probably finish it before the 2 weeks is up. But I suspect you will want to stick around and at least for a few months, get into that tactical volatility course. And when that's completed, you'll either leave or you'll stick around because I have shown you that I have a valuable product in your life, but that will be up to you. So yeah, go to the website, claim the free trial, not going to be charged. And thank you everybody for tuning in. Next week, we will be doing a live stream. Knock, knock, unless I get hit by a bus. I will be back next Friday to close out that VXX short put option. So for me, it's 10:30 at night. Good night, everybody. Thanks for coming.